Ganeshram, thanks very much for taking out the time. How is it that you are viewing the markets currently ahead of the budget?
Morning. We've been cautious pretty much now 15 months. We've been highlighting that there are a bunch of risks which have been playing out, and our portfolio strategy has been to be defensive, stick to the best managed companies in the country, time-tested businesses who have delivered across cycles. Stay put with companies whose growth expectations have been lowballed, valuations are not expensive, and the downside is limited. So we believe that if a portfolio is kind of barbelled with this strategy, downside is limited, and that should protect capital. We continue with that in the at least till we see some improvement in the macro. We'll stick to this stance. Budget, not too sure what material impact it could be. We should expect some kind of populism, which I think market is largely penciled in. What happens to the drivers post that to the macro remains to be seen. So as of now, stance is more defensive.
Right, and Ganeshram, what is it that you are betting on in terms of an opportunity in the markets, or would you stay off making fresh investment calls and wait only for the budget outcome first to make an assessment of where the opportunity lies?
No, it's not too much about budget. Our assessment is earnings downgrades will kind of continue for at least a couple of quarters. So our mind is working more towards how much downside is likely to some of the expectations of fiscal 20 earnings. Where can valuations kind of disappoint? And we have always seen a three-phased cycle in terms of sequencing of the market. For example, the calendar 18, the first 3 quarters, first 3 quarters till about September, stock prices fell, but earnings expectations for fiscal 2019 and 20 were pretty much intact. Not surprising to us, and subsequent, we have always believed there is a phase 2 where there is earnings cuts and market realizes that actually stocks didn't fall due to multiples, but it was more earnings led, and then subsequently there is a correction for earnings expectations. We believe we are still in that phase, and for the lower earnings growth and lower return on equity, we still don't think valuations are weighing that in. So we believe that it's still a grinding phase, and we need to stick to companies who have delivered across cycles, not just up cycles. And so it's more a quality first, value first, which is our priority. We are kind of wary of cyclicals, NBFCs, government spend dependent companies, especially government capex dependent companies. We are wary of more the discretionary or larger ticket size, the leverage dependent ticket size, discretionary consumption also. So it's more a safety first portfolio strategy which we have been adopting, and that kind of continues.
Right. Just wanted to understand, Ganeshram, since we have had a very rough patch, especially for small and mid caps. The kind of damage that we've seen just last year equates to about a 24% fall in the small cap index and, roughly about 17% in the mid cap index. Do you sense that 2019 is going to bring about as much pain, or do you think there's better hope of a recovery coming in this year? Or do you still sense that the tilt of the market and of the investors would remain with large caps?
We are not able to conclusively tell that we have turned the corner. There are some things on the macro which are improving. These are lead indicators which are typically 3 quarters ahead of earnings. Markets tends to start reacting to this. We are still not getting confidence for us to start thumping the table and tell we have turned the corner. Oil has fallen about, it's gone up again, but broadly it's still about $15-20 below where it was, say, 6 months back. So we are broadly, that is a savior, but there are many other headwinds which are still there. We still don't think the banking sector, NBFC sector liquidity is completely resolved. We still believe there is tight liquidity. RBI has been helping it through open market operations, which we don't think is sustainable. We still do believe that the rupee pressure will kind of sustain. 60s is a sweet spot for overall currency dynamics, but there are challenges there as well. We do see some issues on earnings downgrade. So for us to get aggressive and start building cyclicals, we don't believe. So we don't look at it as a mid cap or a large cap bias. There have been some very, very well managed stocks in the mid cap space which have done very well last year also. So it's not large cap, mid cap mindset that we work. It's more on what kind of managements they are. Are they cyclical? Do they depend on the macro a lot? Do they depend on variables, external variables, or have they created shock absorbers? Do they have the managements found variables, avenues for growth to continue in spite of the vagaries? So it's more focused on that rather than try to just broad base it as large cap and mid cap.
So if we were to see any individual selective recovery within the broader universe, what pockets do you find attractive? Where do you see that, you know, valuation and growth alignment is happening and there are opportunities that one can look at to invest in?
Corporate banks, definitely. It's becoming a little more crowded trade over the last 6 months. We still think you will see the NPA, the corporate NPA cycle has kind of peaked out, and we should see positive surprises in that pack. That is something that we think will hold. If it is coupled with a strong retail liability franchise, that's our ideal financials mix that we look for. So CASA funded, retail liability funded, corporate assets, wholesale assets mixed. That's the ideal mix. Another set of stocks where there is some value which we see still is some pockets of IT still. We are looking out for what could be the potential challenges which can come if the Western world, developed world, starts going into any slowdown scenario. But right now, at least in the immediate visible future, we don't see that threat. So we kind of remain overweight on IT. Staples has been more quality management. That kind of continues. But yeah, it's really not brought the risk down a fair bit.
Okay. What would you avoid in this market? Very simply, I mean, what is it that you would not want to touch with a barge pole?
Still think NBFCs are an avoid space. Life insurance we think is a lot more cyclical than what market believes. We think it's still not a structural growth market. It is a cyclical market. So we have been wary of that space. What we are also wary of, all the construction, in some form even cement, or all the government's capex dependent companies, both central and state government capex. We've been wary of some of the automobile stocks which are more discretionary consumption or leverage dependent space. That's something that we'll avoid. Even the energy companies, upstream and downstream oil companies, something that we have been wary of and we have avoided pretty much for the last 15 months.
Okay, great to have you on the show. Thanks so much for taking the time out and really